Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today's episode is a powerful one, and honestly, it's extremely timely if you're watching the development and capital markets right now. Before we jump in, I want you to ask yourself, how are some developers still breaking ground when the rest of the industry is sitting on the sidelines? Do you actually know what real risk mitigation looks like in a ground-up deal? And most importantly, before you invest passively, how do you really vet a sponsor to make sure their execution matches their pitch? If you've ever asked any of those questions, you're in the right place today, because today I'm talking with Justin Goodin. He's the founder and CEO of Goodin Development. He's someone who's actively developing high-quality multifamily and mixed-use communities right now. He's in one of the most challenging development environments we've ever seen. So we're really curious today on how Justin's getting deals done. We'll dig into that. So we're going to break down exactly what he's doing, how he protects his investor capital, and how passive investors can sharpen their due diligence to choose the right operators. So let's get into it. Justin, thanks so much for coming on the show today.
Yeah, thanks for having me on, Kent. Excited to chat.
Yeah, a little bit of background. So Justin and I have known each other for quite a long time. Justin and I actually, did we meet through the meetup? Was that right?
I think so, yeah.
I think so.
Your meetup you were hosting it originally, correct?
That's right. And then Justin and I back in 21, right? 21, yes. Mm-hmm. We bought a deal together, actually two deals together. And those deals have just been fantastic, kind of down the fairway value add deals. And then Justin from there has just continued to progress in his real estate career and now shifted into ground up development. So really excited to reconnect with Justin today and see where that journey's taken him and kind of where he's at now. So again, Justin, well, thanks for being on the show. And let's kind of get into this first topic, right? So if you read the headlines or just understand the industry, a lot of development has slowed down, right? The development pipeline has really ground to a halt in 2025 from what it was in 23, 24. And that's projected for the next couple of years. And so I think it's interesting how you seem like you're really scaling up on the development side. So the question begged to be asked is, how are you getting deals done when everybody else seems to be sitting on the sidelines?
Yeah, great question. I'll jump into that here in 1 second, but why I think now is a great time to invest and build, ground up multifamily. When you look at the data, like what the supply trends are telling us, we saw this peak supply come online in 2024, 2025, a little bit more in 2026 projected, but when you look at the projected supply that's coming online in 2027 and beyond, I mean, it's way back down to 2013 levels at like historically low levels for supply. So why I think now is a fantastic time to be in ground development. If this demand for apartments continues and supply is going to tank, I just think that's going to put, tremendous pressure on rents and occupancy to grow in the coming years. I don't see like houses becoming more affordable in the coming years. I mean, the supply is still really short on houses. So I think a lot of these fundamentals points to why ground up multifamily can be, a great asset in the coming years. How we're still staying active in this, turbulent market times and high interest rates and construction costs, et cetera, we find ways to partner with municipalities to get these projects done. What does that mean? We are finding different ways to partner with these cities as far as incentives or partnership programs to work together with these cities and towns to build these projects. Developers have different strategies. Some do more like workforce housing or cheaper builds. There's high-end luxury A-class properties. We're sort of like in that A-class, more like modern mixed-use communities. And, those are not cheap. Those are, as you know, like not cheap to build. They definitely have a high cost for that high-quality product. So to combat that and make the project financially feasible for us, we're working closely with different municipalities to make these projects happen. Without the partnership with the city or town, those kind of projects don't happen. It's just not financially feasible at this time.
And what I completely understand what you're saying. I believe all the supply and demand dynamics that you just outlined. I mean, it's really essential to our thesis as well. And so when you're looking at new development, right, and we're talking about how a lot of these deals aren't starting these days, right? A lot of deals aren't getting off the ground. It's really slowing the future supply. But what is it that's changed? Why are these deals not getting off the ground?
I think the market is, shifted. As far as occupancy is a little bit lower in some areas, rent growth has flattened out or even gone negative in some cities. Not so much like in the Midwest and Indiana where we are at now, but there's been a lot of supply has come online, which is then gave the renters more of a choice of where they're going to live. Thus, more supply in the market kind of just decreases the occupancy and rent growth. So there's a little bit of that, that the high supply come online. There's a lot of, uncertainty about the outlook of the future, how that's looking. Construction costs have definitely increased since COVID. Building materials, interest rates have elevated. All
Mm.
those factors are sort of making like this perfect storm to make a new development and more, in particular, high class, high end projects really difficult to pencil out.
Yeah, I agree. I mean, if I'm going to narrow in on two things, I think to me it's construction costs and interest rates more than anything else. And that's where this gap of because the space that you're playing in, right, on these public-private partnerships, the reason they're so critical is because of the gap in costs to create the property and versus the immediate value of the property, right?
Correct.
When it first comes online. And that's the difference between creating a C class property with vinyl and lower level
Mm.
finishes versus an A class property with honestly the exterior finishes that cities, municipalities want to see, right? Brick, stone, expensive things. They want to see amenities. And then the renters on the inside, they want to see high end finishes, right? They want to
Mhm.
see high end countertops, sinks, appliances, all these things. And so when you think the way I've always thought about it is it's that gap
Correct.
that exists that has to be filled because if you were going to you can only get so much debt on a property from a construction loan standpoint, right? You're
Mhm.
usually maxed out at about 65%. So if you're going to fill the rest of that gap up with equity, the problem that becomes is there's so much equity that required in the deal that the returns are so diluted that at the end of the day, it's not worth it. And we'll talk about risk later, but the risk isn't worth it for that investor, right? To take
Correct.
on. And so who has to step in? Well, it's the municipality that really steps in. And that's where that partnership is formed, right? Which I think is so cool is the ability to have them actually put some skin in the game, because they're most of the time deferring future taxes, right?
Mhm.
Income that would be coming into the town because they understand the growth and the need for growth, and they want high
Mhm.
quality buildings, not cheap buildings. And so
Correct.
that's cool how you get the win all together there for you, the municipality, the equity investors because they get a fantastic return, right? Because part of the equity coming in eventually comes from the municipality in some way. So, but yeah, I mean, I think where construction costs have gone and interest rates have gone, even though rates have come down a little bit, it's still really difficult to get those solid deals to pencil, right? And
Agreed.
you consider land value too. I mean, land values, especially in
Yes.
desirable areas, have gone up considerably. So I think you and I believe that long term, there's still a lot of value to be created there. Um, but it takes a partnership. It takes a public partnership to really, really create that value, I think, at this point. So I'd love
Agreed.
to hear what you're doing there. What do you think, as you've been looking at your deals, what are you seeing? I mean, how are you underwriting your construction? I mean, how are you seeing things pencil out? I guess the better way to ask that is, I mean, what are you really looking for in a deal these days? What are the things that are making deals work? And then maybe go into a little bit about how are you partnering with some of these municipalities?
Yeah, I guess like when I'm, evaluating different projects, like what tells me if a deal is, quote unquote good or not. I mean, one, I want to have a good buffer of contingency in there, somewhere between 5 and 10% of project cost as actual contingency in that project for like any kind of like what ifs or unpredictable
Mhm.
things that come up in the project. So having some sort of buffer room in there. Secondly, we're not trending rents through construction period. So, construction period might take anywhere between 12, 24 months sometimes. We're taking a look at the market today and making our assumptions about the rents about, 18 months or 24 months down the future. And that's our projection. Like we're not taking rents today and then trending those rents or growing those rents, through that 18-month or 24-month construction period. So
Mhm.
we're using that data today to make those assumptions about 2 years in the future and just sticking to that 0% rent growth. As far as like how we, partner with different municipalities, TIF financing is a pretty common strategy, tax increment financing, where the city can issue a bond, the developer can sell the bond and, earn more proceeds in way of that. There's also, cash incentives, state grants, forgivable loans, all these things that all these, resources that towns and cities utilize. It's all going back, like what you mentioned. It's covering that financial gap. So what that financial gap is, it's if you spent $20 million to build a project, that doesn't mean it's worth $20 million. We all know, like in commercial real estate, your value is kind of dictated by the rents and the income that property produces. So you might spend 20 million to build the project, but it might be worth 15 million when it's all said and done and when you cut the ribbon. And that $5 million gap, that's the financial gap that prohibits properties from being built. And that's how we partner with different cities and towns to make that happen.
That's right. That's right.
Mhm.
And I think that explanation of that gap is important, but then, I mean, it begs the follow-up question of, well, then how do you create the value for the investors? Because at the ribbon cutting, maybe it's worth this. From there to when you're selling it, how are you creating the value that then makes that worthwhile?
So yeah, the great question. The cities and towns we're partnering with, I mean, we consider them like real partners in the project, but they're not equity partners, so to speak. I mean, they're providing incentives to the project that we don't pay back. So they're not like a real equity partner. They don't share in the upside in the project. The upside is, shared with the partners and all the investors in the deal. Um, the city or town, and they're just like involved in the beginning and just helping us get that project off the ground and make it financially feasible for the developer.
I gotcha. And I
Mhm.
think I think too, right, you're creating a ton of value by actually leasing the property, right? Getting it
Oh,
full and
correct.
creating that income stream.
Hmm.
And then, that really what then you create that multiple on that income stream to really create a ton of value when you go to sell,
Correct.
right? Because I mean, I don't think there's any better I don't think there's any more way to create more value in real estate than taking something from raw land to a leased up building, right? And that's
Yeah,
why you can have tremendous returns for your investors in that kind of a deal. So,
correct.
yeah,
Creating
very
value from
cool.
scratch, quite literally.
Very cool. So, you touched on it a little bit, but, the next thing I wanted to talk about is one thing I appreciate in your approach is that, you're transparent about risk. You talk about risk. Ground up developments definitely have a different risk profile than a value add project, right? A building that already has people in it and is already making money, and maybe it's done that for several years or 30 years. Um, And I feel like that's something that LPs don't often, limited partners, investors, right, don't often fully understand. So I'm wondering if you could break down for us, what are the major risk levers in development? How do you mitigate those risks? And as much as you can, you kind of compare and contrast with, maybe a more vanilla value add type of deal.
Yeah, I mean, of course, there's risk in any kind of investment. There's risk in value add, risk in development, but I think there's some common like misconceptions that all these development deals are just extremely high risk, extremely high leverage, and super speculative. Um, you know, there's many ways that you can mitigate risk in a construction deal. I mean, one of my favorite ways is to always have a GMP contract with your construction company. So a guaranteed maximum price in your contract if your costs were to go over that contracted price for a reason, the contractor is actually on the hook for that overage. It's not a totally safe, end all be all, GMP, but it does mitigate a lot of the risks that come with construction costs. Other than that, you can have a really awesome, general contracting team, architecture team, civil engineer team, all these different sort of experts in their field. I think really help you mitigate the risk on these projects. Like you don't have to be an expert in civil engineering or architecture or the construction side. As a developer, you're sort of like at the top of the food chain in a way, and you're leveraging all these different expert parties to help you have a successful project. So those are some different ways, just as far as like building your team, always having a GMP, building in supply constrained areas, having buffer room in your underwriting. Typically, like these projects we're doing are lower leverage. So I mentioned like some development deals you hear about being like 80%, 90% leverage. Our last project was 55% loan to cost. So there's a ton of equity in these deals that, investors probably don't realize, but there's, low leverage and a lot of equity in these deals with these public-private partnerships.
Yeah, and I think that's a good thing to touch on, because that was another question I had, is how does you started talking about it, how does the public-private partnership lower the risk through the project, right? The ability to have lower leverage is a piece of it, right? But like dig into that a little bit more and talk about that dynamic when you look at it from the lens of the limited partner or the actual equity investor in the deal.
I mean, first, the limited partner is going to know that this project is backed or approved by the city. If the city is willing to partner with that developer and provide incentives to get this project going, the city and town is always going to evaluate the developer, the project, their assumptions. It's not just any project gets these incentives, and sometimes this can be a very substantial investment from the municipality. So it's not just any kind of random project that can get these incentives. So that right there, if the project is a public-private partnership, that should give the investor a lot of confidence it's been thoroughly vetted. Other than that, I mean, just by looking at the project as a whole, like looking at their team on the development side, I mentioned the contractor, the civil engineer, the architect, all those team members sort of go together to have that successful project.
Yeah, I mean, it sounds like you're thinking about trying to mitigate a lot of the risks on the front end, right? Like through the team you choose,
Correct.
Right? The expertise that you surround yourself with, the way you contract, right? The fact that you're putting contingencies into your project to anticipate any overages, even though you have a guaranteed max contract, right? There could be change orders and things that come up. Things always happen that are unexpected, right? So having some dollars set aside for those items is critical. So it sounds like you're trying to mitigate a lot of the risk on the front end by just planning better for it and by the team you put around you. And then, maybe even talk about as you get into the construction project, how are you kind of managing that piece of it to continue to just manage risk, right? Because I mean, we all know anybody's built anything, it never always goes exactly how you plan. There are things that come up. So what's that look like managing through the process to continue to identify and mitigate risk?
Yeah, like when the project is, in the construction phase, as a developer, you're sort of on the sidelines to an extent, but you're working closely with the contractor to manage them and manage the project. So you're reviewing the budgets and the costs. You're visiting the project site weekly. I mean, at least that's what I do. You're walking the actual project site, making sure the floor plans are correct, making sure that like any kind of mistakes you guys talked about the week before are mitigated that following week. So you're walking the project on site consistently to sort of like catch like any kind of changes or mistakes that could be had. So I mean, it's not something you can just like sit at home, hire the construction company, they'll go build it. Everything's all going to be all good and fine. Like you still have to be like on site, on the job, talking to the contractors, managing the budget, managing the cost, And we, of course, things are going to come up, things go wrong, things happen. Hopefully, it's not going to be like anything substantial. That's why you always have that contingency baked into your budget. Some developers will defer their development fee. I know for us that we defer 2/3 of it into the project. So instead of taking our full development fee like up front, we take a third of it at closing and then keep 2/3 of it into the project as contingency. So if it's
Uh-huh.
not spent as contingency, it gets paid out as a fee at the end, but that just adds more room and more buffer into the budget as well.
Yeah, I mean, I think that's a great way to put some skin in the game, right?
Hmm.
And to leave some dollars into the deal for what may come. So yeah, I like that. What's something that LPs think is a big risk, but really isn't when you kind of manage it or plan for it appropriately?
In the development side,
Yeah, yeah, just in general, and all that we're talking about. Like, is there something that's a misconception?
I would go back to the high leverage and high loan amounts on some of these projects. Just because the project can take on more debt doesn't mean it's always good to take on more debt. A lot of these projects are going to be like DSCR constrained. So you don't always have like these super high loan amounts in development projects. At least like that's what I've seen so far. Like our last two projects were 53 and 55% loan to cost. So I just think that's always like a common misconception that all these deals are just super high leverage to make them work, to make them pencil. That's not always the case with ground development.
I gotcha. I gotcha.
Mhm.
Let's shift gears here to another topic around, something I think our passive investors need to hear. Something I love to talk about is how do you vet a sponsor? So, most LPs don't do nearly enough due diligence. I mean, it's tough because it's just lack of knowledge, lack of time. So, if we can help people to really, condense that process into what really matters, right? From your perspective, what are key things an investor should be evaluating when deciding, not even for the deal, if the sponsor's trustworthy and capable and somebody they should invest their money with?
Yeah. I mean, one thing that you can always do is ask for like real investor references from the sponsor. There's also another kind of like newer platform online called investclearly.com. Not affiliated with that site at all, but it's a free site that LPs can go on and leave verified reviews on sponsors they invested with. So I always, highly recommend any kind of LPs going on this site, investclearly.com, and looking at these real verified reviews of sponsors that people leave. Other than that, you can just ask around. It's a pretty small world of commercial real estate. You can talk to like other people they partnered with, other investors on online forums and Facebook groups. I mean, you'd be surprised. It's a pretty small world in commercial real estate that you can get like a pretty good idea of how the sponsor operates and how their past deals have performed.
Yeah.
Last thing I'll just touch on because maybe people don't mention it is background checks. You could always do a background check on the sponsor you're investing with. Pretty simple, pretty easy to do, but I don't hear a lot of people doing that. So I think it's a pretty easy way to vet a sponsor and kind of see who you're getting into business with.
Yeah, I'm curious. I mean, there's a lot of information out there today. I'm curious, how can you tell the difference between somebody who's actually operating well versus somebody who's just really good at marketing?
That's a good point. I mean, you can't always go past somebody's LinkedIn profile or their fancy websites or their credentials on the website. I think you have to have like real, verified reviews of the sponsors. At the end of the day, of course, it's always a risk who you're investing with. Past performance doesn't equal future performance, but you can do your homework on the front end by just talking to real investors that have invested in their deals. So, like just going back to that site, investclearly.com, I think is a great resource and will become a lot more mainstream here in the future soon.
Yeah, interesting. That could be a great resource. So, Justin, as we take our look into the future, curious, what are your thoughts on kind of where are we going from here? How are you looking at things? Where do you see opportunities, or how do you see the market changing? Over the next year or so?
Sort of like what I mentioned in the beginning, but I do think that demand for apartments will stay strong and consistent. And then if this supply cliff does happen in, 2027 and beyond, I do think that'll sort of, help rent growth in the coming years, occupancy increase in the coming years. So my outlook on apartment investing is really, very positive, very strong. Um, I guess like where I get worried is the whole sort of just shift into this AI world. We're hearing about these different CEOs and companies that are directly laying off people as a result of AI and the new things that AI can do for companies. That is one thing that I do get worried about is how the outlook on employment is going to look with different, AI coming into the workforce. But of course, like there's always opportunity. There's like, a lot of uncertainty when the internet came out, but look what happened there. So I'm cautiously optimistic about the future, but hopefully it'll work out okay with all the AI stuff.
Yeah, I agree with you on the AI. I mean, it's interesting. If you look at the unemployment rate of kind of entry level positions, if I don't remember what the exact
Yes.
range was, but something folks from maybe 22 to 26 or so, it's something like 10%. So considerably higher than the 4% we see, globally as the unemployment rate. And I think beyond that, even we're just not seeing people. Layoffs are starting to happen a little bit, but it's more just through attrition. They're just people aren't being backfilled, right? Somebody leaves, they're not backfilled, and there's not a lot of active hiring going on. So it's definitely an interesting time.
Yes.
But I also agree with you. Like, I mean, if you think about these disruptions that have gone all the way back to, I mean, probably every time in history, right? Like this, when the steam
Yes.
engine was invented, right? Or the printing press, right? It's all of a sudden, oh man, what are all these people going to do?
Yeah.
And there is a shift, right? But people, evolve and they'll find new jobs, and coders will become prompt writers or something, And so, I'm sure there'll probably be a couple of years where it gets figured out, but I imagine it'll get figured out. But yeah, it is a real thing right now, especially when you think about among young people. And
Agreed.
people trying to get entry level jobs. I mean, it's tough out there for sure.
Yeah.
And those people can be some of the biggest renting populations, right? So we
Exactly.
think about what
Exactly.
what happens to those folks in the near term
Mm.
is definitely something um, to be mindful about. I think be mindful about. I think also digging in probably to markets where there's more of a concentration, right, of these kind of entry level tech jobs, which are some of the jobs that are really being disrupted by AI. So it's might be good to be part of your how you pick your markets too. And look at the job concentration. And very interesting stuff. Well, Justin, I mean, thank you so much for coming on the show and hitting us with some development knowledge. Um, as we let you go here, what is some way that how can everybody get a hold of you is what I'm trying to say here. How can they reach you? How can they learn more about what's going on at Goodin Development?
Yeah, thanks. Anybody can connect with me on Facebook and LinkedIn, just Justin Goodin on both of those social platforms. Also, goodindevelopment.com. I have a free 7-day passive real estate investing 101 email course. You can sign up if you want to learn like the ins and outs of passive real estate investing.
Well, fantastic. We'll make sure that's all listed below. And thanks again, everybody, for joining us on Ritter on Real Estate. If you find the episode valuable, make sure you subscribe on Spotify, Apple Podcasts, YouTube, wherever you're listening to it so you don't miss any episodes. And as always, just everybody invest wisely, live well, and we'll see you on the next episode.